All right, let's dive right into this explainer. We're going to take what is normally a massive, intimidating 40-term Forex glossary and transform it into a simple step-by-step journey. The goal? Getting you to read a trading chart like an absolute pro. So whether you're completely new to the markets or, just need a quick refresher of your technical vocabulary, we're breaking these core concepts down so clearly that you'll know exactly how to use them out there. Let's get right into it.
Here's our roadmap for the life of a trade. We're going to quickly cover the Forex playing field, the mechanics of a trade, managing your account money, navigating market forces, and finally, smart risk management.
Section 1. The Forex playing field. Setting up the arena. So, first up, a currency pair. This literally just means trading one type of money for another. For example, EUR/USD. That's just a shorthand way of saying you're trading euros for US dollars. Simple, right? Now, to actually make that trade, you're going to need a broker. Think of the broker as your personal gatekeeper app. It connects your phone or computer straight into the live market.
Now, here is a super fascinating contrast in how you can actually make money in this space. When you buy or go long, you're betting the price is going to go up. It's kind of like buying a rare collectible today just to sell it later for a profit. But get this, you can also sell or go short, which means you expect the price to completely drop. Imagine borrowing a toy, selling it for $10 today, and then buying it back for $5 next week to return it. You just pocketed the difference. Pretty cool, right?
So, to predict those wild price moves and actually decide whether to buy or sell, traders rely on two main strategies. First up is technical analysis. This is exactly like reading a map of past charts to predict where the price is headed next. On the flip side, we've got fundamental analysis. Instead of looking at charts, this is a lot like checking the weather before you step outside. You're looking at economic news, interest rates, and big global data to guess where that price is ultimately going to end up.
Section 2. Mechanics of a trade. The math and rules.
Okay, let's talk about lot sizes, which is literally just the actual size of your trade. As you'd expect, bigger lots equal bigger money and, of course, much bigger risks. A standard lot is 1.00, and man, that carries high risk. A mini lot is 0.10. But I really want you to notice that micro lot right there at 0.01. It is the absolute smallest, safest size, and honestly, it is exactly where a beginner should start. Actually, pro traders always use an online lot size calculator just to make absolutely sure they're picking the safest size for their account.
And that leads us right into leverage. Think of leverage as a trading superpower that lets you play with way more money than you actually have. So a leverage of 1 to 100? That means if you only have $10, you can trade as if you have $1,000. No joke. But look, we have to be real here. While borrowing that power is incredibly exciting, it is absolutely a double-edged sword. It's going to drastically amplify your wins, sure, but it will do the exact same thing to your losses.
Next up on the vocab list is a pip. When you're actively in a trade, you track your progress in pips. So what is it? A pip measures the tiniest, almost microscopic steps a currency price can take. So say the euro to US dollar price moves from 1.1000 to 1.1001. That teeny tiny shift of a single digit at the very end, that is exactly 1 pip.
Now, the moment you finally hit that button to enter a trade, you're immediately going to encounter the spread. If you look closely at your screen, you'll see a buy price and a slightly different sell price. That little gap between them, that's the spread. It essentially acts as the broker's small fee for letting you play the game. The smaller the spread, the better it is for your wallet. Though keep in mind, instead of a spread, some brokers might just charge a flat commission fee per trade. But honestly, most primarily just rely on the spread. Moving on to Section 3, Managing Your Account Money. Protecting your stash.
Let's quickly break down the vocabulary of your actual trading wallet. Your balance is simply your starting cash. Easy enough. Your equity, though, that is completely dynamic. It's your balance plus or minus your live trades, meaning it is shifting by the second. Then we have margin, which is basically the mandatory security deposit you need just to open a trade. And finally, your free margin is whatever leftover cash you have to actually play with.
But looking at that raises a rather terrifying question for any trader. What actually happens if a trade just goes aggressively against you and that precious free margin starts to completely vanish?
Well, that's what triggers a margin call. You can think of this as a blaring red alert warning siren from your broker. It means your drawdown, which is the amount of money you're currently losing before closing a trade, has gone way too deep. Your broker is essentially stepping in to tell you, hey, you do not have enough money left.
You either need to add funds immediately, or they're going to step in and forcefully close your trades just to protect whatever little cash is left in the account.
All right, on to Section 4, Navigating Market Forces, the live chaos.
So when you're staring at a chart, you'll notice prices move in trends. They can be uptrends, climbing higher, downtrends, falling lower, or even moving sideways, just completely flat. But as they move, they tend to ping-pong between two invisible barriers. Support acts like a bouncy floor, where the price often stops falling and jumps right back up. On the flip side, resistance acts like a heavy ceiling, where the price stops rising and gets shoved back down. That is, at least until a sudden breakout happens. That's when the price violently smashes right through that support or resistance range, which usually creates a massive trading opportunity.
And the market actually has a daily rhythm to it, broken up into global trading sessions. The day kicks off with the slow, relatively steady Asian session. But as the globe turns, the London session wakes up, bringing massive, high-volume trading. And finally, we get that crazy overlap into the New York session, which is absolutely famous for high volatility and huge, sweeping price swings.
During these sessions, you're going to run into a whole mix of wild market dynamics. You'll see volatility, where prices jump incredibly fast, and liquidity, which dictates how easily you can buy or sell without causing a massive ripple in the price. Sometimes, in really fast markets, you'll even get slippage, which is crazy, because your trade actually executes at a totally different price than the one you clicked. This usually happens during massive news impacts, like the famous NFP report, which can move prices dramatically in literally seconds. Honestly, these wild conditions will dictate your whole style. Are you going to use a fast scalping strategy, grabbing tiny profits in minutes? Or maybe a swing trading approach, holding trades for days to ride those much bigger waves?
And that brings us to our final section. Section 5, Smart Risk Management, Survival and Victory.
Look, every single trade has an entry point where you start and an exit where you close. You can enter the market right this second using a market order, or you can set up a pending order to automatically enter later when the price hits a specific level. But guys, here's the absolute golden rule. You must always use a stop loss or SL. This is your financial seatbelt. It automatically closes your trade if things go south, preventing a massive blowout if you take an SL hit. Conversely, you'll want to set a take profit, or TP, to automatically lock in your cash for a TP hit. The bare minimum goal in any rough trade? Try to at least hit your break-even point, where you make zero profit but take zero loss. You basically just get your money safely back.
Oh, and a quick heads up. If your strategy involves holding that trade open overnight while you're asleep, definitely keep an eye out for a swap or rollover. It essentially acts like a tiny hotel charge, or hey, sometimes even a reward, applied to your account simply for staying in the market from one day to the next.
So to actually survive this arena, you've got to follow these crucial rules. First, absolutely practice on a demo account. That's your fake money training mode. Second, enforce a really strict trading plan to keep those emotional, impulsive mistakes in check. Third, never risk more than 1 to 2% of your capital on a single trade, period. And fourth, make sure your risk-to-reward ratio actually makes mathematical sense. If you're risking $10, you should be aiming to make 30. Honestly, if it's not at least a 1 to 3 ratio, it's just not worth the risk.
Well, there you have it. With all 40 of these core concepts completely demystified, you now genuinely possess the technical vocabulary of a pro. So let me ask you, what is stopping you from opening a free demo account today, designing your own rock-solid trading plan, and putting this powerful new knowledge to the absolute ultimate test? The arena is fully open. The charts are moving right now. Is it time for your first practice trade?